Well, another week, another fresh take on where the housing market's going. In the past month, all our major banks have changed their outlook for house prices, and they're now predicting the biggest housing crash in decades. Over the weeks, the Economists of the Commonwealth Bank and the National Bank forecast house prices to fall 10% next year. Westpac expects a slightly smaller fall, only 7% in 2023, but a further fall in 2024 of 5%. And ANZ Bank economists believe we're going to have a softer landing with only 6% falls next year. But will they be right? Now, of course, these forecasts are based on the assumption the Reserve Bank is going to start raising interest rates this year, and that our housing markets are going to be collateral damage to the Reserve Bank's efforts to keep inflation in control. Now, only a couple of weeks ago on a previous podcast with Dr. Andrew Wilson, we went into great detail about our thoughts on these wild predictions. And if you haven't listened to that episode, I'd really recommend you go back and listen. And our regular listeners know Andrew's got a great track record on property forecasts, but in that episode he explained the reasoning behind his more bullish forecasts very well. However, since then, stories of falling house prices don't seem to be going away in the media, so I thought I'd spend today discussing my thoughts with you. Just you and me, no special guests on this particular show, and I'll give you even more reasons, why I can't see our property markets crashing ahead. By the way, at the end of today's show, you're going to have more clarity, you'll have more certainty about our housing market's futures, so welcome to today's show.
Welcome to the Michael Yardney podcast, where twice each week you will learn a number of new ideas regarding success, property investment and money in around 30 minutes. Our show is brought to you by Metropole, who specialise in helping you grow, protect and pass on your wealth through strategic property and wealth advice. Now here's your host, Michael Yardney, Australia's authority in wealth creation through property, who has been voted one of Australia's top 50 most influential thought leaders.
As I said in the introduction, all the major banks are predicting rate rises this year. Some are suggesting rates will rise as early as June. And they're also predicting property values to drop significantly in 2023. So I guess the question all property investors and homeowners are asking is, will this really happen? Now, we know the Reserve Bank's being patient and it may not even raise rates as quickly as many are expecting. And I don't think they're going to raise interest rates as much, as high as many people are predicting. They're not going to need to raise rates that much to start to slow the markets down when they're ready to. And I'm not talking about the property markets. They're wanting to slow inflation down. That's what will eventually happen. And if that's the case, then the ramifications for the housing market are unlikely to be as dramatic as those property crash predictions that you've been reading about in the media. Now, of course, the banks have already started raising fixed-term interest rates over the last couple of months, and there's little doubt that we've already gone past the peak of house price growth. I'm not suggesting property values are going to drop anytime soon, but the pace of growth is going to slow as already high house prices and the bottoming of our interest rate cycle erode affordability. Remember, property values have gone up 20%, 30% in most locations, and wages have hardly gone up at all yet. In fact, real wages are going down because they're not going up as much as inflation. But at the same time, this year, and starting at the end of last year, property buyers have had more choices because vendors are placing their properties in the market for sale. More vendors are, I guess, trying to take advantage of what they see as the peak of the market before any major changes in interest rates occur. Anyway, back to the original question, the topic of the discussion I want to have with you today. What does all this mean for house prices moving forward? Now, before I give you the answer to that, I'd like to work through some of the factors likely to influence our property markets and the drivers that will affect house price growth over the next year. Now, you've probably read about my thoughts on this in my blogs on Property Update and in my previous podcasts and my YouTube videos with Dr. Andrew Wilson. But recently I read a great blog by senior economist at the REA Group, Eleanor Craig, and she wrote an article in PropTrack discussing the current outlook for rising interest rates and what it means for housing. So I want to give her credit for some of the following commentary, and in fact the order in which I've discussed these points this time round. So firstly, what's going to happen ahead in this year? Well, even if the Reserve Bank doesn't raise interest rates, I think mortgage rates are going to be rising independently. Hey, that's a silly thing to say. They've already started going up, haven't they? So fixed rates in particular, the ones that have gone up, they've risen off their record lows. And I know because I recently locked in my interest rates. Hey, that's not a recommendation to you, but I locked in about 2/3 of my property portfolio's interests. And the rate I had to pay for 5-year interest is about 0.5% more than I would have had to before Christmas. So fixed term rates have gone up, but variable rates, interestingly, are falling at the moment as competition amongst lenders still remains strong. This means new borrowers haven't necessarily seen their budgets shrink. They can still borrow their home loans or investment loans on variable rates at very low funds. However, moving forward, the cost of money to the banks is going to be rising, in part because of overseas funds costing more as well. And so I think in due course, variable rates are going to head higher later this year too. And of course, even more so if the Reserve Bank does raise cash rates later this year. But I can't see that happening until late in the year. Of course, rising interest rates, mortgage rates will restrict the amount new borrowers can borrow, and existing borrowers are going to have higher repayments. Now, already high home prices and the increased cost that borrowing is going to be will slow the annual price growth, but it doesn't necessarily mean property values will drop. Of course, falling interest rates makes borrowing cheaper, easier, allows people to borrow more, and it's been one of the factors pushing up property values. But history shows that rising interest rates don't instantly, suddenly cause property values to stop or slump. If we look back at the past, it's only been when there's been consistent, long-term, multiple rises in interest rates that the property market eventually slows down. Now, sometimes the Reserve Bank's been keen to slow the property markets down in the past, as have APRA, but this time around, that's not on their radar. They keep saying over and over again they don't want to slow the property markets down, so interest rates aren't going to go up to the level that will cause property values to slump. But yeah, mortgage rates from the banks will go up. Having said that, despite rising interest rates, I still think repayment costs for housing are going to remain historically low. I think when the Reserve Bank raises rates and interest rates go up, they're only going to go up a little bit. The Reserve Bank usually increases them by 0.25 or maybe even a bit less than that, and not quarter after quarter. So even though borrowers will see higher repayments soon, maybe even sooner than they anticipated, the Reserve Bank's likely to increase rates slowly. They've learned from the past. They're not wanting to stop the economy growing. That's the exact opposite of what they want. They're just wanting it to not grow too quickly. So overall, repayment costs are still likely to remain low by long-term historical standards. So if your rents go up and the value of your property goes up, you should be able to afford slightly higher mortgage costs. Having said that, households are sitting on a once-in-a-generation boom in savings, despite the ravages of COVID, the pandemic, and despite the lockdowns. The Reserve Bank statistics and the Australian Bureau of Statistics figures show Australians are wealthier than they've ever been. Household savings, and that corresponds to the ratio of household income saved to household net disposable income during a certain period. So what people are actually saving, income minus outgoings. In the September quarter of last year, the household savings ratio increased to 19.8% from 11.8% in the June quarter. Now, this was partly driven by lockdowns, particularly in Sydney and Melbourne, where households really couldn't spend a lot of money. But we've been saving our money. We've been paying forward our mortgage bills. We've been paying off our credit cards. And in addition to that, government support payments, tax relief, dividend payments have seen, for many people, incomes increasing. And at the same time, households, as I said, have been spending less. And so this has actually given them significant savings, a war chest of savings, a cushion for households to fall back on if mortgage rates go up. And that's one of the reasons I don't see property markets crashing. People aren't going to suddenly sell up their home at silly prices. They're going to just take it a bit easier for a while. They're not going to spend as much. Many are already months ahead on their mortgage payment anyway. So for property values to crash like the bank's expecting, people are going to have to sell up their properties. There's no reason for that to happen if they've got this war chest of savings. At the same time, Australians' assets have gone up. Their household wealth has surged. Each month, the Reserve Bank shares in its chart pack what our net worth is. So, in other words, we've taken on more debt, but our assets, in particular our homes, and for many people their investment properties and their superannuation, have gone up significantly more than the debt has. Household wealth has surged. Australian Bureau of Statistics data suggests that Australia's housing market is the most valuable it ever has been, and our household wealth has hit an all-time high, up 20.2% on a year ago, the largest annual gain in over a decade. So the rise in value of our assets has placed household balance sheets in a historically strong position. Now, clearly, not everybody's assets have gone up. Those who own assets, real estate, shares, businesses have done well, and tenants and renters haven't, but they're not the ones that are going to be affected by rising interest rates either. But the point I'm trying to make is that at times of rising interest rates and at times of rising inflation, those who own assets are going to do well if they own the right assets. So it's actually going to be really important at the end of this cycle, and that's going to come over the next couple of years, that you don't own the wrong assets, because moving forward, those areas where people's wages are going to go up, where more affluent people live, where their mortgages are at a lower loan-to-value ratio because they've owned their homes for a while rather than in the outer suburbs, they're going to outperform over the long term. By the way, that's the sort of research my team at Metropole does. We don't look in the rear vision mirror at what's happened. When I change the way I invest by looking at leading indicators, forward indicators, rather than the rear vision mirror like most economists and most people do, it changed the success of my investing and also that of our clients. So we look at where there's going to be future growth in jobs, growth in the economy, growth in population, growth in disposable income, because that's going to translate to higher property values. And we're also looking for those areas where tenants are earning more so they can afford to live there. So as we're going through this, I'm just trying to explain to you why I can't see a housing market crash ahead. We're sitting on a once-in-a-generation boom of savings. And apart from the savings, the money side of things, our assets have gone up as well. Now, moving forward, what about the property markets? Well, I still see strong buyer interest there. I mean, our team at Metropole are getting more inquiries than they have for a long, long time. And there is still proportionately a low volume of stock, of good stock on the market. Buyers now realise that not all properties are going to increase in value as much. They're being much more selective at the moment. Now, they should have been last year as well, but the usual supply and demand factors are going to underpin our property markets moving forward. At the same time, investors are going to enter the market as well. So some of the other drivers that are going to drive our property markets moving forward are investors who always come late to the party in property cycles, and they've read that property values have gone up and rents are starting to rise and they feel like they're missing out a bit. Now, those who bought a year ago, 2 years ago, they're sitting pretty, but those who are buying into the property market now really need to be very careful. A rising tide doesn't lift all ships, and in our estimates, about 4% of the properties currently on the market are what we call investment grade. So if you want some direction, some clarity, some certainty, if you want my team at Metropole to help you through these more challenging times, why not go to metropole.com.au and find out about what we do, because you're going to find it safer to work with us in these challenging markets than not to work with us. Interestingly, an audit of our clients, a couple of years ago now, it was 2020, showed that our clients are 7.3 times more likely to own 7 or more properties than the average property investor. We've got a framework. We've got the perspective because we've lived through these cycles before. So that means we've got a system that's known, proven and trusted to help you develop wealth, grow, protect and pass on your wealth through independent strategic advice, because we don't sell properties. So go to metropole.com.au and find out a bit more about what we do. Anyway, back to what's going to drive this property market. Apart from investors, homeowners, they've accumulated substantial equity in their homes. I mean, the property values have gone up a lot, but they've also got slightly different preferences. Some are understanding that workplaces are going to be more flexible in the future. Remote working arrangements are more acceptable now. So housing preferences have changed. The size of the house, everyone seems to need a Zoom room and a bit of yard, being in the right location and the right amenities, because the local amenities become more important when you don't have to go to work in the CBD anymore. Sure, there's headwinds ahead of us with economic uncertainty and election coming up, geopolitical problems overseas. But overall, low borrowing costs, ongoing capital growth, attractive yields are going to attract investors, and home buyers are still going to upgrade their homes because they've got so much equity. Now, in the old days, many would just renovate. They'd add another room, they'd add upstairs, they'd renovate the insides. But with the shortage of tradespeople and the extra cost of renovation, I'm finding that a lot of people who would have probably done that in the past are instead now thinking, no, it's just easier. It's easy to sell homes. There's so many buyers at the moment, so they're selling their homes and upgrading. So all these extra homes on the market don't necessarily mean that there's going to be a flood of homes that are going to pull down property values, as some people are suggesting. And that's because they've forgotten that most sellers are buyers also. So homeowners put their house on the market and they've got to buy something else again. Now, what are the other factors that are going to affect our property markets moving forward? Well, inflation is going to get higher. But that's not at this point pushing the Reserve Bank to raise interest rates. They're also waiting for wages growth to occur. Now, the money market's expecting interest rates to rise sooner rather than later, and some are even suggesting there's going to be a number of interest rate rises this year in 2022. But the Reserve Bank keeps saying, be patient. We are patient. We are patient with respect to raising interest rates and inflation. So unemployment is starting to come down, but the Reserve Bank's still wanting the wages growth to remain high, not just go up once, and it hasn't gone up much just yet. They wanted wages growth closer to 4%. So overall, our economy is improving. We got through the pandemic. Employment is rising. Unemployment is falling to decade lows. Now, adding to all this, though, our borders are starting to open up. And 200,000 people are going to come into Australia. Now, they're not going to actually buy property straight away. Some are on visas, won't be able to. Others, first of all, want to work out where they want to live, settle their families, get new social networks, get good jobs, so they rent as well. So I see another factor affecting our property markets this year are rising rents. So even if mortgages do go up, investors are not going to bail out because they're going to have the rising rents to be able to support their higher mortgages. So the Reserve Bank doesn't want to raise interest rates too far and too fast because they recognise it would promote a weakness in the economy, would slow down the economy, would slow down the housing market. They know that that would mean that there'd be fewer people having jobs and wages wouldn't go up. And that's actually the exact opposite of what the Reserve Bank's wanting. They're looking for full employment. They're looking for Australians to have more wages. So these outlandish predictions of high and rising interest rates to crash our markets, they're preposterous. Let's be clear, the Reserve Bank doesn't want the housing market to crash. As you've often heard me say before, it wants that about as much as it wants another strain of coronavirus. Now, sure, at the moment interest rates are low. They're low to bolster the economy, to stimulate inflation, to increase wages growth. And once the Reserve Bank believes that's all under control, comfortably, but also consistently, so that inflation is within its desired band of 2 and 3%, unemployment's low enough to cause significant wages growth, then they will raise interest rates, but not to levels that are going to slow the market down to neutral levels. And with the extra debt that a lot of us have got at the moment, and I'm sure you're reading about that too, they won't need to raise them as much to just bring things back to neutral. Of course, there's some conjecture as to what neutral is, and I think what a lot of the other economists are suggesting is that they're going to go up to what they used to before. But that's old theory. The Reserve Bank realises that they don't have to do that because of the general level of household debt. So, as I said right at the beginning, if interest rates don't go as high or up as fast as many are suggesting, then the property market's not going to crash. Now, remember those people making those predictions of house price crashes 2 years ago thought we were going to have a house price crash. All those bank economists said double-digit property price falls will occur in 2020, and then they were late to the party in 2021 last year. They don't seem to, despite the banks lending to all these homeowners and property investors, the bank economists don't seem to have a handle on what's going on in real life in our property markets. So I see that this cycle will slow down. It always does. I'm not suggesting property values don't fall, but I believe the falls will be moderate and that not all property values will fall, and the more affluent and the wealthy areas tend to hold their values a bit better. Now, they are volatile. During boom times, the most expensive suburbs go up a lot and then they slow down a bit. Same with holiday locations. But if you're talking about the middle ring suburbs, big capital cities where homeowners have got a lot of equity in their homes, there's no reason for property markets to crash. So just remember, in general, Australia's households are wealthier than they ever have been. They've got more equity in their homes because of the property boom. And over the last couple of years, the bank's stricter lending criteria have ensured that those who are borrowing, those that are getting the new funds, could withstand a 2 or 3% rise in interest rates. That's the buffer that the banks put in to protect themselves. So if interest rates rise, most of the borrowers are going to be able to cope with it. Now, there's no doubt that some investors have overcommitted themselves. There's no doubt that some first home buyers have bitten off more than they can chew. And that's why we tend to avoid those particular subsegments of the market when recommending properties for clients at Metropole. But again, please remember that most Aussie households have taken advantage of the low interest rates. They're 3 or 4 months ahead in their mortgage payments. So the bottom line is, you don't have to lose any sleep. The housing markets won't crash. The value of your home won't plummet. But yeah, the market will slow down, but that happens every cycle. And one last point I guess I want to say again is interest rate rises won't occur until the economy has strengthened significantly and consistently, and inflation has remained within the comfortable band for the Reserve Bank, and wages have increased, not just one or other of those. And hopefully you now have enough notice that if you are having some challenges with your finance, if you're not in the right position to withstand higher interest rates, you better get yourself organised by seeing your mortgage broker. But on the other hand, if you want to take advantage of the opportunities this stage of the market brings, and you don't want to get caught in the traps, why not have a chat with my team at Metropole? Go to metropole.com.au and find out about what we do. I mentioned to you earlier that we don't sell properties, and we start by putting a strategic property plan together for our clients. And sometimes that means it's not the right time to buy property. Sometimes it means it's a good time in the cycle to get rid of the underperforming properties so you're not stuck with those and you get the right sort of property to take you through the next stage of the cycle. We have a range of services. You may want to use some, you may want to use all. Property strategy, buyer's agency, wealth advisory, renovations, development, property management, business advisory, financial planning. Metropole.com.au. I'd love to be part of your ongoing wealth creation journey.
Now here's Michael's mindset message. Remember, a change in your thinking will lead to a change in your life.
In my mindset message today, I'd like to share with you one habit that powers Bill Gates and also Elon Musk's success. One of the common things that unites Jeff Bezos, Elon Musk, been hustling for the top positions of the world's richest people for a while, and also unites them with Bill Gates, is books. In Bezos' case, it's not just that he founded Amazon, initially as an online bookstore way back in 1995. I actually remember when that happened. I guess I'm old enough. And it's not that he married novelist Mackenzie Scott, not that they're together anymore, but it's that he continued a lifelong habit of reading, one that at some point inspired him to recreate the browsing of bookstores online. Now, Bezos particularly loves novels, especially science fiction. He said he learns from novels more than he would from non-fiction books. Now, I remember reading in Brad Stone's comprehensive book on how Amazon was built, he described books as having nurtured Amazon since its creation and shaped its culture and strategy. Now, similarly, Elon Musk, that I know a lot of people look up to and admire, he devoured books from a young age as well, reportedly reading up to 10 hours a day, reading whatever he could get his hands on, including the entire Encyclopedia Britannica. Now, for younger people, they may not even know what that was, but boy, that was a huge selection of books that door-to-door encyclopedia salesmen used to sell, and they cost a fortune to have on your bookshelves. Elon Musk apparently once said, "I read books in response to the question of how did you get your idea to build rockets?" We've heard of stories of other uber-successful readers, including Warren Buffett, who one point suggested anyone who followed his path to success has to read 500 pages a day. Now, I read a lot, I write a lot, it's part of my life, isn't it? But boy, I'll never get to 500 pages a day. And Bill Gates, he also reads for hours a day, and he says he reads a ton of science fiction, and he used to, especially as a child, and he mainly reads non-fiction now. And of course, there's Oprah Winfrey, who over the years has inspired a lot of people with her book recommendations, and she personally transformed the career of a lot of authors. So if you think about it, why is reading so important? Reading is essential in creativity, in innovation, and for learning from the outcomes of history. It's an opportunity to open your imagination to other possibilities. And that's really the process behind entrepreneurship. So reading can provide characters, ideas, both fiction and non-fiction. They can motivate you, they can inspire you, they can give you role models, they can teach you about mentors. You can have access to these in your out-of-book world. And books offer a place to expand your knowledge, your language, and your ability to concentrate and focus. Not to mention, of course, the joys and the pleasures that come from simply reading. A break from the pressures of life, an opportunity to engage in something out of your world. So in many cases, it's reading that's not only provided direct ideas and inspiration to some of the products or services these entrepreneurs I've been talking about have built, but also the knowledge and discipline they needed to make things happen. My good friend Tom Corley, who wrote the Rich Habits book initially after studying the habits of so many successful millionaires and comparing them to the poorer people in America in his study, and he's since written our joint book together with me, Rich Habits, Poor Habits, he found one of the common traits of all successful people was their love of reading and their ability to read, not just for recreation, but for learning. So some books have got answers. Others simply provide space for your creativity, for your inspiration, that can help such answers evolve. So now with all these books read and all those billionaires with billions to spend, let's hope you can find some inspiration to build your wealth and start reading, learning, improving. Hope you got some benefit from my mindset message today, and that's a great habit to teach your kids as well, isn't it? I hope my explanation about what I see ahead for the property markets is going to give you a little bit of comfort moving forward. By the way, I've been investing for close to 5 decades, which basically means that I've lived through these cycles before, and I think that perspective helps me. Now, if you got some benefit, if you do understand more about the markets now, and you know somebody else who'd also enjoy learning these things, please tell them about the Michael Yardney podcast. Please just tell one person. I can see our audience grow show by show. I'm very pleased by that. Having said that, I want to make as many Australians, as many people in general, financially independent, so help me on my quest. Now, if you want to, you can tell the whole world, like Damien Vandenberg did. He actually sent a review in on Apple Podcasts and said, I started listening to this podcast after reading Rich Habits, Poor Habits. I love the weekly insights into what's happening in the market and the economy, which gives me the confidence to make well-informed investment decisions without all the negative media bias. Keep up the great content. Always looking forward to new episodes and your upbeat and positive attitude around wealth. Now, Damien, actually, he emailed me, and so therefore I've got and jumped ahead, because normally I say if I read out one of your reviews, I'll gift you one of my books. Well, I've already done that for Damien, and if you leave a review and I read it out, I'd love to gift you one of my books as well. In the meantime, though, I've got a gift for you, even if you haven't left a review, my way of helping you. Just go to podcastbonus.com.au. There'll be a link in the show notes, but podcastbonus.com.au, and I've got a bundle of reports and ebooks for you. I'll be back again real soon. In the meantime, you can catch me on social media. Just look for Michael Yardney, or join our private Facebook group. Look for the Property Update Facebook group. As I said, I'll be back again real soon. In the meantime, have a great week. Make it a great week.
Thanks for listening to this episode of the Michael Yardney podcast, which was brought to you by Metropole, who help their clients grow, protect, and pass on their wealth through strategic property and wealth advice. If you like what you heard and don't already subscribe, you'll find us on iTunes or on your favourite Android app as the Michael Yardney podcast. Watch out for our next show, which comes to you twice a week, and you'll learn some new ideas about property investment, success, and money in around 30 minutes. To get more of Michael's thoughts, go across to www.propertyupdate.com.au and sign up for his daily morning briefing, and you'll hear from not only Michael, but a group of leading property success and money experts. And just a reminder that the information you heard in this show today is general educational advice and not specific investment advice, as we don't know your personal circumstances. If you're looking for specific advice, why not ask the team at Metropole to help you?